Hi, I'm Gwen Preston of Resource Maven with yet another comment on the GDXJ rebalance. So a fund that's supposed to track the mining sector is currently having an outsized influence on the sector. It's a weird backwards situation, but it's fairly significant at the moment. The fund is, of course, the Van Eck ETF GDXJ, which is the Junior Gold Miners ETF. Now, it's several years old, but when gold turned from bear to bull in early 2016, investors started flooding into this ETF. They were looking for exposure to this rising gold market. And the result was that the fund got bigger and bigger and bigger. As the assets in the fund grew, the fund had to continue deploying that cash into shares of the companies that it owns. That's the nature of an ETF. The thing is that GDXJ was allowed by its own self-described rules only to buy companies with a market cap up to $1.5 billion. The thing is, the junior mining sector just isn't that big. So as the funds kept showing up and they kept buying more and more shares, this passive investment fund ended up owning way too large a stake in a whole bunch of the companies that were involved, up to sort of 18-19% of about that many companies. That just doesn't make sense. A passive fund can't own such a controlling stake in a mining company. And if GDXJ had gotten as far as 20%, the securities rules mean that that should spark a takeover deal, which clearly doesn't make sense because we're talking about a fund. Anyways, it all meant that GDXJ realized it had to fix the problem. It came out with an announcement in April saying, we have to rejig. We're going to raise our market cap limit to $3 billion, and we're going to actively sell stock in any company in which we own more than 10%. So our ownership max is going to come down to 10%. What we don't know is bigger than what we do know. The market has really reacted to this. Companies in which the GDXJ owned more than 10% have really come off. Investors are selling in expectation that the fund will sell, and that will create pressure on the stock. Investors have also, because those prices have come down of the stocks that the fund owned, the fund itself has come down. That's meant that the fund has also had to sell. Just like when money came in and it had to buy, when money exits, it has to sell. So we've had all of this downside. But the funny thing is we don't actually know how or exactly when or exactly what the rebalance will look like. Perhaps GDXJ has already been selling, and that is part of the downside that we're seeing in these stocks. We don't actually know. An announcement is expected any day now that might clarify the situation. But at this point, it's a lot of guessing, and investors, rather than guessing wrong, are erring on the side of caution and doing a lot of selling in advance of this situation. Of course, there's opportunity on the buying side as well, but the companies being added to the fund are the really big ones, companies with a market cap between $1.5 and $3 billion. So the opportunities there aren't as obvious as for the stocks that have been really hurt by this selling. Now, when I say opportunities, there really are some. Stocks have come off a lot because of this expected GDXJ pressure. That's created, I think, some really good entry opportunities. Two kinds. One, stocks that are just a trade. They came off a lot because of this whole situation. They will likely rebound, and so you can just trade that rebound. The other category of stock is companies that you've always perhaps liked, but you wanted an entry point. Some of this selling has created entry points in some of those more value-oriented stocks that maybe you've been watching for a while. Perhaps this is the opportunity. So that's my take on GDXJ. We'll still see over the next week how this all plays out in detail.